Every dividend tells a story. Today we're looking at the story CHPY has been telling me. A year ago, I never expected this ETF would become the biggest income producer in my portfolio. But month after month, the payments kept growing until it quietly passed every other holding I own. Today I'll show you why that happened, whether it's sustainable, and the one mistake I think investors make when they only look at the yield. So stay tuned. Welcome back to Simply Money. If you've been following my monthly income reports, you've probably noticed one ETF keeps showing up at the top of the list, CHPY, CHPY. It's now producing more income for me than any other position in my portfolio, including SCHD. But this isn't a video about chasing the highest yield. In fact, if that's why you're here, I think you're going to be surprised by what I'm about to show you. Today we're going to dig into the story behind those distributions. We'll look at why the income has grown, what's driving those payments, how CHPY fits alongside more traditional holdings like SCHD and QQQI, the risks that come with owning it, and why I believe its job in my portfolio is completely different from my dividend growth funds. Because understanding why an ETF is paying you is just as important as knowing how much it pays. Let's dive into our worksheet. For those that are new here to Simply Money, thank you for joining us. This is our dividend growth sheet. I use this to track individual ETFs, when I get paid, how much I get paid, how many more shares I buy, all that good stuff. We're going to go through the history of my CHPY holding, and I'll give you a bigger picture of my portfolio after, and the new tool that I use to update this and to monitor my whole portfolio, as well as some of these important data points, the metrics that are important to me. But what we want to look at here is the CHPY rundown. Back in September of 2025, I decided to get into a little bit of CHPY, just a small position, wanted to test it out. I was doing some research. I really liked its underlying. For those that don't know, CHPY holds 30 companies, all in the semiconductor sector. And I'm really big on the semiconductor and quantum computing as opportunities for the near future of some pretty good growth. But not only does it have a lot of upside opportunity, but I'm also looking to build my income portion of my portfolio, the actual income generated, as I prepare and get ready for retirement in the near future. This fit where I was looking. I wanted something that had upside potential. I did not want a share price that was declining. Even if it had a bigger income generation that outpaced the decline, that wasn't what I was looking for in this position. I was looking for something that paid a healthy income, and this more than does that. If you're not aware, you will see in a moment. But I was also looking for something that had share price appreciation opportunity. And a lot of people will say, well, you should just own SMH or SOXX. Well, I do own some SOXX in my growth portfolio, but I own this in my income portfolio because I'm building that to help generate income, to sustain my retirement, to live off, for my family to be able to have income that exceeds our need. That way, if something like CHPY, my biggest payer, drops back 50%, I have a buffer where I can continue to draw that income and not have to sell shares. Yes, for people wondering, I do have a cash reserve, and I will continue to build that up the closer I get to retirement. So I'll have that basket and that bucket ready in case the market goes into an extended downturn, that I can draw out of that if need be to offset the income. But remember, if I'm producing, let's just say I need $6,000 to live on, and I'm producing $9,000 and it drops in half, I'm only getting $4,500 income, and that's where that cash would be nice for that extra $1,500. I still don't have to sell any shares. Some funds like CHPY will have that potential if in the long-term semiconductor pullback happens, if we're in an extended bear market. That could happen. That can happen with QQQI, SPYI. It could even happen with SCHD. It's much less likely, but it could happen because SCHD has not gone through an extended market. It did handle 2022 very healthy. You can check out other videos on the channel under this playlist, but CHPY, that's the reason I got into it. At the time I got into it, about $24,000 in it. The price was $50 per share. I'm about 486 shares. So this is what's happened since then. We're going to go over a few things on the sheet. Again, if you like this dividend growth, you can get that down at Buy Me a Coffee in the link below, and all our spreadsheets are available there. But what we do on this is I get the dividend. So I bought this on September 26th. It's a weekly paying distribution. So remember that, unlike SCHD, which is quarterly, this is a weekly payer. So these payments are every week. I want you to look at here. Our first distribution was just under 41 cents. Our first payment was just under $200. Share price had already jumped up significantly there. We were only able to get 3.5 more shares, but we added those to it. And you can see our portfolio balance went up about $3,500. Let's look at the growth of the distributions first. You have around the 40-cent mark here, went up, jumped nicely in the end of October, 58 cents, came back down. This is one of those things right here in December, came down to 38 cents. And after it got up to 58 cents and been right in the 40-cent, you can see it dropped a little bit for a while. And this is one of those moments where people think, oh, it's starting to decline, NAV decay, you got to watch out for yield max, all the different comments. I see those and I understand, and you have to look at it. Why is this down? Well, part of it is the share price is down. You got to remember, SCHD is paying the distribution. They're setting what the dividend is. Let's say this most recent one was 25 cents, and they pay that per share based on the share price. That's how you get your yield. SCHD's yield might fluctuate down to 2 something if the price goes really high, and if the price goes really low, I've seen it almost at 5%. In fact, back in 2020, during COVID, the yield was close to 5% because the price had dropped so far. And that's where these differ. They keep the yield about the same. So if the price goes down, the yield stays the same, but the distribution goes down. We call it a dividend, but it's actually a distribution. It's paid off premiums because they're doing covered calls on the underlying companies. This is where people would be like, oh, it's going down. I'm going to panic. I don't like this, I'm getting out. But they don't look at the reason. Know why it's going down. Don't just look at it and say, oh, it's going down. Is it going down because all the underlying companies are going down? And is that because of the news and the fear amongst other things? Or maybe they're just pulling back. And I'll show you one of those scenarios near the end on how you can see that and correlate those and realize it's nothing to be afraid of. Now, if their underlying processes are changing, if they're going down and the underlying companies are going up, that's a caution. I'm going to look into that much deeper because there's some reason why if the underlying companies are going up and the ETF is going down, there's something that I don't like there. I'm going to investigate that. That may be when I pull the plug. I don't know. I can't make that decision. But I don't make the decision just on the dividend or the share price. I want to show you both of those. The dividend distribution, got down to 38 cents, but then look at this. A few weeks later, it's back up to 53 cents. Then we continue down, and it's just grown and grown. But then, oh, look, fear again, it's down to 38 cents. But watch what happens. Look at this rally that we've had. And yes, the semiconductor rally, and really the whole stock market had a really big run through April and May. This wasn't abnormal. You're seeing the share prices on everything going up, thus the distributions follow. Again, as the price goes up, the yield stays the same, the distribution goes up. But again, it went down for a little bit, but then look at this, we got up to 60 cents, and then the highest one we got was back here in the end of June. Look at that, almost 78 cents. Back here, if you had panicked thinking, oh, this is going down, this is horrible, look at that, 38 cents at a $54.50 price. Now look at this, we got up to 77 cents and an $85 share price. So not only in this time frame from September until the end of June, the share price has gone up 56%. That is incredible growth. Do I expect it to sustain that? Maybe, maybe not. I expect over the next 5 years, I'm going to see some huge pullbacks. We might see this drop down to $35 if a really bad bear market hits or recession hits. I don't know. I can't predict the future, but I know if the underlying hasn't changed, if it drops down, that's when I start looking and saying, maybe I'll add to it. Maybe I'll get a bigger position in this. I don't know. I have to monitor my allocations too. Where am I at with my funds and all my allocations? And here now, the next payment was 66 cents. And here's the other thing. Just like the distribution per share can fluctuate, and this stock price can go up and down. We'll look at that real quick. You can see here, got up to $58 and it went down to $54. And people just get panicky very quick. We got up to $87. I think for a short period, maybe one day, we hit right at $90, and it's down now to $78. And this is where people start panicking, but I'm not panicking. You know why it's down to $78 right now? AMD's down. Everything's down in the semiconductor realm for the most part. There might be some individual companies here and there, but most of the sector and a lot of the stock market has been down. We had a huge run up, and anytime you have a huge run up, there's always going to be a little bit of pullback. I don't know how long the run up lasts. I don't know how long the pullback lasts, but it's typical. You can look at any stock market, any ETF fund, and look at its graph. And you're going to see some big run ups, and then you'll see a big pullback. Then a big run up and a big pullback. The beta is telling you how much volatility there is. How fast does it go up and down in comparison to the S&P 500? The S&P 500 is the standard of 1 beta. If you compare it to that, something like SCHD is about a 0.85 beta. Means it doesn't go up as fast nor down as fast. It's less volatile. That's your stabilizer. You can look at something like AMD. That's very volatile. Its beta is going to be like 1.5 or something. I don't know exactly what it is. But for an example, the more volatile it is, the beta will be higher. So when you're looking at the summaries of ETFs or stocks, that's something you want to look at is what is the beta in consideration to your goals, to your risk tolerance, to your outcome, and know that. So when you go into something, realize I'm going to have to be able to ride some of these ups and downs because the ups will be bigger, but the downs will as well. And that's something you'll have to keep an eye on and realize to keep your emotions in check. As you can see, our share price went up tremendously. I want to overview a couple things here. Now look at these payments for June. $458, $402, $494, and $511. For those who haven't seen this, this is on my monthly update every month. I show the symbols and when I got paid and how much I got paid in dividends. And just to scroll down for this one, CHPY, $1,838. That's how much this is paying me a month right now. If you look back here, it was paying me about $800 a month, give or take. That is the growth that this thing has had because of the share growth. And that's one of the reasons I chose this, because I knew the dividends could go up and down, but I also felt very strongly the semiconductor sector would be going up and I would capture that. Again, I'm going to lose some upside compared to SOXX or SMH, but I'm going to continue to get that income, and that is what is important to me for when I get ready to retire. I'm working on getting my income level to a certain place where I can take the income I need and reinvest all the excess, and I have a goal in mind where I want that. And then if I do lose some income, I have options to deal with that. But let's just say, for example, I need $6,000 a month, and I retire making $9,000 a month, and I can reinvest that $3,000 a month into other funds, more CHPY, more SCHD, more some of my other income funds, or into my growth funds. As I'm doing that, maybe by the time we reach a bear market or a recession, something really pulling down my income, maybe I've increased my income to $10,000 a month. And I still only need, maybe with inflation, $6,500. I have a $500 cushion greater than when I started. And that is my goal and part of what I'm setting up for my retirement plan. And one of the reasons why CHPY fit into that plan very well. The new tracker I use is right here. It's called the Simply Money Portfolio Manager. And it shows you a lot of great metrics here. Now, it builds with you. So when you initially get this, you put in your portfolio where it currently stands, and you go ahead and enter in a few little things here. It doesn't take much time. And then to maintain it, each time you get a payment, each time you make a buy, anytime you sell, deposit, or withdraw, you put a transaction in. You just put in what account, the symbol, number of shares, the price, if there's a distribution, and the transaction amount, and what you want to do with it. I want to reinvest it. I want to take cash, and it puts into your cash pile so you can see how much cash you have to do investing, or you can redirect. I've updated mine from this time moving forward because I want to track from here forward, but I did put all my SCHD in to be able to track that from the beginning. If you haven't seen that video, go ahead and check that out. I show you my SCHD outcomes from the beginning. It's in the playlist that you're on. And with all this, you can see I put in all my SCHDs. Here I put in a withdrawal because when I made the sale, I did a withdrawal. I bought some other stuff, so I put that withdrawal in here, and that would go to the cash after you sell it. And then the cash, I said withdraw, so it withdrew, so I could put it into other funds and another account. This will track all that, and then it updates your portfolio. So it basically takes what you started with on the portfolio builder, and then all the transactions you've put in from the transactions tab, it updates automatically everything, your accounts, the symbol, current shares, average cost, current price, market value, gains or loss, gain and loss percentage, current yield, yield on cost, annual income, and I'll show you some of these features I really like, your monthly income, my retirement contribution. So because I haven't put any transactions in from anything else, it only thinks that I'm getting income from SCHD right now. But as I keep adding transactions from here forward, this will slowly get into actual amounts that I'm getting paid now from these other accounts. But it's telling me if I was retiring, I don't want 100% coming from one fund. And you'll see in a few months when I get some more data on here, how this changes and how important this is. Shows your allocation percentage, what you're currently at. And this here, your income versus allocation. I get a lot more from SCHD because everything's basically allocated to that. And that'll show better once we get more data in there. You can also see your income report, and this is the part I like watching. And you can see some of this right here, annual income, monthly income. This is my snapshot. This is what I'm looking at. I look at annual income first. I want to know if I retire today, what's my annual income? And again, this is up to date. If you want to watch other videos that I've done showing my monthly income updates, that'll show where it's actually at. This I'm still building to get it up to date, but just showing you its wonderful highlights. This tracks your portfolio yield because I only have SCHD reporting yield at this time. It only shows that and how many income producing funds are there. There should actually be 10, but I haven't put any transactions for these other funds yet, so it assumes there's no income. This isn't set up to show you how much you've done in the past. This is going off from what you put forward, where you're at, and the more you put in there, it'll build that and start averaging it. Let's say I put one distribution transaction for AMDW, it's only going to average that one. But if I put 12 in, it's going to average those 12, and it takes in consideration if there's decline. What it's doing is it's giving you an outlook, and so after 2 or 3 months, you're getting a better overview of what your annual income is, what your monthly income is, and what's producing funds. And some highlights you can see down here, which isn't important right now. We'll go over this in another video. But I wanted to show you that so you could see what CHPY has been doing and how you can track your portfolio, because a lot of people are asking, how can I track my portfolio? Those are available down below in the description, as always. The other thing I wanted to answer was, how does CHPY fit in with the rest of my income portfolio compared to, say, QQQI, SPYI? Well, this is how I look at it. One, it's a less of a long-term hold. And I say long-term, when I think of long-term, I'm thinking 5 years minimum, 10, 20 years. SCHD is, for me, a hold it forever. Unless something drastic changes, I'm holding it forever. QQQI, SPYI, those are definitely long-term holds for me. Again, unless anything can change, but the plan is, based on underlyings and things, is to hold it long-term, and then I might have to make some adjustments because I see those providing steady, reasonable income, reasonable yields, and some upside. Not a ton of upside, 1, 2, 3% growth on the share price per year on average. Some years it may be negative, other years slightly higher. But over 5, 10 years, if I see that 2, 3% growth of the share price and the yield continues to be around the same, averaging out again over periods of years, not just month to month, I want to see that continue to remain at the 13, 14% yield. My tiers are permanent, long-term, then shorter term. CHPY is more of a shorter term. I don't know how long semiconductors will be bullish. I think an easy 5 years. I think there's still a lot of growth with AI. and semiconductor needs, I think that demand is going to remain high, but maybe it'll be 2 years. So that is just stuff to look at and consider. In CHPY, I will watch the semiconductor funds, and not just when they go in a bear market or recession. Sometimes you can gauge that on the sector, and you can gauge that on the market as a whole. If semiconductors are just beat up to death and technology as a whole is booming, maybe I'll look into it deeper. If the whole stock market is just busted up to pieces and CHPY and other semiconductor markets are down, I'm not worried about it. It's just following the market. There's things to look at beyond just is it up or down, and that's something I monitor. And especially with these shorter term holds for me, I will continue to monitor this. These type of funds for me require more effort. And the last thing I want to share with you is don't just chase yield. Yes, this yield is very attractive, but that should not be your whole reason that you look at that. Because of that, one of the things I developed is a Simply Money drip score with income versus decay ratio. I want to show you this real quick if you've never seen this. This is a real big favorite of a lot of people. Sorry for some of the NAs. The market's closing and it's doing its thing. This sometimes will do that. Don't panic. Sometimes it takes a minute because things don't read. But I want you to look at CHPY. Thankfully, that one's updated. And you can see that the price appreciation, again, this time frame is based on these individual sheets. I'll just show you AAPW. You have these drip sheets like the one I showed you, and it gives you different scenarios. And this is where the data is coming from. And I have it from a different date than my personal one. This is 3 months earlier. So the data is going to be slightly different. You can set the date you want to check. And again, it shows you your price appreciation and then what your total return was for full drip, no drip. But what I want to point out here is green means it's better to drip than it is to take cash, and by how much? 15% better. You can see here that you got 95% total return on full drip and only 79% on no drip. You did better by dripping on total return. Doesn't mean you should. You may want to take the cash because you need it, and it would still be a good fund, and we know that because the income versus decay ratio, this lets you know there is no decay, the price appreciated. If there is decay, for example, AVGW, means the price depreciated, but the income outpaced it, so you still got a positive total return. And then the drip opportunity score lets you know right now, if I was to buy this and I got a distribution, would it be better? Would it be a good idea to drip it? You can see with CHPY, it got a 94 score, which puts it in the elite status, meaning, yeah, it's very healthy to drip this. Not only are you doing well, you're doing exceptional. Whereas something like BETH, it's saying you got a negative return, your income is not keeping up with the decay, and it's not really a great place to drip. If I did own it, I would look at not buying it, obviously, or maybe getting out of this. I'd have to look longer term. This is set at a pretty short term right now, so don't take that. That's the big thing. Remember to go set in whatever things you're looking at. What is the time frame you want to compare? But for CHPY, and this is something I would look at, maybe put that down to 3 months. Do I see that declining? Put it up to, can't go for this one for 2 years, but put it as far back as you can. How is it done long term? Am I seeing a bad trend? That's just a tool. None of this is foolproof. This is just to help you make the best decisions you can. I provide all the tools for those that want it, and I do all of the videos for those that don't want, and I try to do the work for you. I'm going to keep doing videos, and I take requests. Send those in the comments below if you have something you want to see. Put that down there. I appreciate it. Leave me some comments. That helps the channel more than anything, and hit that like and subscribe button. That's it for today. I appreciate you joining me. We'll see you next time on Simply Money.